Ever wondered why your money disappears so fast? The hidden tricks banks use will shock you. Most people believe banks are simple places that store money safely, pay small interest, and help the economy run smoothly. But the uncomfortable truth is this: banks don't just hold your money. They actively control how it moves, how fast it shrinks, and how much power it has over your life, often without you noticing at all. Welcome to Meta Economy Lab, where you can learn and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning. To understand how this control works, we need to go back in time, long before mobile apps and instant transfers. Modern banking systems were built centuries ago, originally to protect wealth and finance trade. Over time, banks evolved from safe storage vaults into powerful financial institutions, shaping economies, governments, and personal lives. In the early days, banks operated on trust. People deposited gold or cash, and banks promised to keep it safe. But soon, bankers realized something critical: not everyone withdraws their money at the same time. This simple observation gave birth to fractional reserve banking, a system that quietly changed everything. Fractional reserve banking allows banks to lend out most of the money you deposit while keeping only a small fraction in reserve. That means the money you think is sitting safely in your account is actually being used elsewhere. It's loaned out, invested, and multiplied, all while you still see the full balance on your screen. This is where control begins. Banks earn interest on money that technically belongs to you, while paying you a fraction in return. Over decades, this system became legally protected and normalized. Governments backed it, central banks supported it, and consumers accepted it without question. Fast forward to the 20th century, and banks grew even more powerful. The creation of central banks, like the Federal Reserve, gave financial institutions access to emergency money, policy influence, and interest rate control. This connected private banks directly to national economic decisions. Interest rates became one of the strongest tools of control. When rates are low, banks encourage borrowing. When rates rise, debt becomes heavier. Your mortgage, credit card, and car loan payments change, but your wages usually don't. This imbalance slowly transfers wealth from individuals to institutions. One hidden trick banks use is timing. Fees, interest charges, and payment processing delays are carefully structured. A payment posted one day late can trigger penalties. A transaction processed overnight can cause overdraft fees. These small timing differences generate billions in profit every year. Take overdraft fees as an example. Banks know exactly when your paycheck arrives and when bills are due. By reordering transactions, some banks maximize the number of overdrafts, not to protect you, but to increase fee income. This practice has been criticized for years, yet it still exists in subtle forms. Another layer of control comes from credit scores. Banks helped create the credit scoring system, and they benefit from it. Your access to housing, transportation, and even jobs can depend on a number calculated using rules you don't control and barely understand. The more debt you carry, the more predictable you become to banks. Predictability is profit. Banks use data to model your behavior, estimate how long you'll stay in debt, and adjust offers accordingly. You are not just a customer, you are a financial profile. Credit cards are one of the most effective tools in this system. Minimum payments are designed to feel manageable while keeping balances alive for years. Interest compounds quietly. Rewards distract attention. The real profit comes from people who never fully escape. Savings accounts tell another story. While banks earned high returns by lending and investing your money, savings rates often stay low. Inflation quietly eats purchasing power while your balance appears unchanged. The loss is invisible, but very real. Digital banking made this control even smoother. Apps feel empowering, but they also increase monitoring. Every tap, transfer, and purchase feeds algorithms that refine pricing, fees, and offers. Convenience masks complexity. During financial crises, the contradiction becomes clear. Banks that encourage risk often receive bailouts when things go wrong. Individuals, meanwhile, faced foreclosure, layoffs, and debt. The system protects institutions first, stability second, and people last. The 2008 financial crisis exposed this imbalance. Banks took massive risks, collapsed, and were rescued. Millions lost homes and savings. Yet after the crisis, banks became larger, more consolidated, and more influential than before. Today, a small number of big banks control trillions of dollars. Their decisions influence markets, interest rates, and economic direction. When they move money, entire sectors feel it. When individuals move money, the impact is barely noticed. Fees are another silent weapon. Maintenance fees, ATM fees, wire fees, foreign transaction fees, and penalty fees add up. Individually, they seem small, but collectively they drain billions from consumers each year. Even payment systems are part of the control structure. Delays in transfers, holds on deposits, and settlement times favor institutions. Your money moves slower than theirs, and that difference creates profit. Banks also benefit from complexity. The harder it is to understand statements, terms, and conditions, the less likely people are to challenge them. Confusion protects the system. Regulation exists, but it often lags behind innovation. Banks adapt faster than laws. Lobbying ensures favorable rules. Consumer protection improves slowly, while financial products evolve rapidly. This creates a quiet tension. Banks argue they provide stability and access. Critics argue they extract value and limit freedom. Both can be true at the same time, and that contradiction is rarely discussed openly. The most powerful control banks have is psychological. They normalize debt, encourage consumption, and frame borrowing as progress. Saving feels slow. Spending feels rewarding. The system rewards behavior that benefits institutions. Yet awareness changes everything. Once people understand how money flows, how fees work, and how interest compounds, the illusion weakens. Control shifts from passive acceptance to informed choice. Some people use banks strategically instead of emotionally. They avoid unnecessary fees, pay off high-interest debt quickly, and keep savings protected from inflation. These actions don't break the system, but they reduce its grip. Looking ahead, banking power is evolving. Digital currencies, fintech, and decentralization challenge traditional control, but they also introduce new risks. The question is not whether control exists, but who holds it next. The story of banking is not about villains and heroes. It's about incentives, structures, and silence. When systems are not questioned, they become invisible. When they are understood, they become negotiable. Here are 3 lessons to remember. First, banks make money from movement, not storage. Second, complexity is not accidental. It is profitable. Third, awareness is the strongest form of financial defense. The warning is simple, but serious. If you don't understand how banks use your money, someone else will always decide for you. The future belongs to those who question systems instead of assuming fairness. If this investigation changed how you see your bank account, like the video, share your thoughts in the comments, and subscribe to continue uncovering how money, power, and systems really work. Meta Economy Lab gives you new perspective to see and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning.